In this record, we're now going to look at the second key financial statement in a set of financial statements, which is the income statement. Now, this is formerly known as a statement of profit or loss, and it essentially looks at whether wealth has been generated over a particular period. So where a statement of financial position was at a point in time, the income statement is for a period, generally a year. Now, this is focusing on profit or loss, which is the accounting concept of wealth. It's not the same as cash flow, and that's important here. To calculate profit or loss, you look at the revenue that's been earned, so the income, less the expenses. Now, we don't mean money coming in and money coming out, because you can earn revenue and not get paid, and you can incur expenses and not have paid for them. And that's this concept called the accruals basis of accounting, or you might often hear it as a matching principle. So when you're preparing a set of financial statements, the profit or loss is done on the accruals basis, whereas the statement of cash flows is just cash in, cash out, which is done on a cash basis. Now, I'm going to show you a little Excel file that I'm going to put up as well that might explain it a bit easier. Let's focus now on revenue first, because we'll have a little expense table in a second, which will make it straightforward as well. So let's focus now from the revenue perspective. Let's take the most simple one down the middle, a company that deals in cash, say SuperValu. So when a customer comes in and you make a sale today, it all goes through the till. SuperValu can recognize that revenue straight away because they've sold the goods, they've earned the revenue. So in the statement of profit and loss, the revenue and the associated costs are recognized today, so they'll show a profit. In the statement of financial position, they'll get the cash in straight away because the customer's after paying them, and the cash will come into the statement of cash flow as well. So it's a pretty straightforward one when the actual customer pays straight away for the goods and the deal is done. Let's take, for example, a sale on credit, where you make the sale today, like a builder's merchant, but you don't pay till later. Pretty standard in a lot of industries, you offer trade credit. However, for the profit or loss statement, you recognize the revenue today. So even though the customer will not pay you for 2 months, 3 months, 4 months, that revenue is earned today when the sale is made. Because you didn't get the cash in, you can't increase your cash as an asset. Instead, you create what's called a trade receivable. So you now have an asset on your balance sheet which says customers owe you money. And in the statement of cash flow, the cash won't come in till later. So see the difference here. There's no difference in this one because cash comes in at the same time as the transaction. Here, you recognize the revenue today, so you're going to show the profit today, whereas the cash may not come in for 2 or 3 months. And that could straddle 2 different accounting periods. Any sales made in December, for example, you may not get paid until then for January or February. So you recognize the profit in the 2021 accounts, whereas you mightn't recognize the cash until 2022. So there can be a timing difference. Right? And if you look for someone, for example, like Grafton Group, if we look at their balance sheet, statement of financial position, they have trade and other receivables 451 million. That's money owed to them by customers for sales on credit. And if you go to note 17, if you wanted to, just go down here, note 17, it'll tell you exactly where the trade receivables are, so what country they're in, and it will also tell you how long they're outstanding. So of those trade receivables, you can see some of them are 60 days plus, and some of them are what we call impaired. What we mean, we don't expect them to pay. So of the 60 days plus, of the 22 million, 8 million, about a third of them, are impaired. We don't expect them to pay. So the loss rate. So that's a difficulty in terms of offering credit. You have this thing called bad debts. They may not pay you. So that's what trade receivables are, where you sell to customers on credit. You can also, however, have the opposite, where you pay in advance. Think of an airline, a hotel, or a gym. You pay for it in advance. So say, for example, Ryanair now, they can only earn the revenue and recognize it when the service is provided. So if I pay for a flight today that's not happening until 2022, Ryanair cannot recognize the revenue and the associated profit with that transaction until 2022. So even though the cash comes in today into the statement of financial position, they also have a liability because they owe me that money until they provide the service. So we won't recognize the revenue until next year, but the cash comes in today. So that means you have this liability on your balance sheet. And if you look at Ryanair's accounts, remember I flagged that to you before, this accrued expenses, come back up here, apologies. The accrued expenses here, 2.5 billion, note 9, that's a liability. If you go to that, note 9, I think we're back here. Sorry, we're not, we're on another bit. Note 9, of that 2.5 billion, 1.4 billion is unearned revenue. That is, customers have prepaid for tickets, but Ryanair cannot recognize that as revenue until the service is provided, i.e. the planes have taken off. So that's an important way of understanding there's a different concept of cash in, cash out than revenue recognition. When you recognize the revenue, that will drive profits. When the cash comes in is a different story. And it won't always be the same period. You can be paid in advance, or you can be paid in arrears by doing on credit. The exact same thing happens for expenses. The easiest is when you pay for an expense in cash today. It's an expense today, goes into your profit or loss statement, and the cash decreased today. However, if you have, for example, prepayment, you prepay expenses, maybe you're prepaying for rent, or you're paying in arrears, for example, ESB, you're using ESB today, but you're not going to pay for that until January or February 2022, then you have to include that expense today. Right? So you include the expenses when they're used, not necessarily when they're paid for. You can pay for them in advance. We call that an asset. You've paid for something, you're not going to use it until next year. That's called a prepayment. And if you go back and you look at here, there'll be prepayments in both these should be. If you look at the statement of financial position, so it might be in other receivables. I think Ryanair have prepayments as well. And they're typically in other assets. So they're prepaid. You can have prepaid expenses. Maybe you prepay rent for the next year, or you can have payments in arrears, where you use the expense in this financial year. So it should be an expense calculating your profit, but you won't pay for it until next year. And that will be classified as an accrual. You owe people money at the end of the year. So I just want to show you that to understand that it's not always straightforward, money in, money out at the same time the transaction happens. There can be payments in advance and payments in arrears. And that can be both for revenue and for expenses. And the reason we want you to emphasize that is that's why we have two different statements. The profit or loss statement focuses on when did you use the expense? When did you earn the revenue? Not necessarily when the cash came in, the cash came out. The statement of cash flow focuses on cash in, cash out. So it's more like a summary of your bank account. And that's quite important for a lot of businesses. Because if you think of it, if you're a business that maybe is offering a lot of trade credit, trying to grow very quickly, but maybe not getting trade credit from your suppliers, you could have cash flow issues quite quickly. So that's what can happen in a lot of startup businesses. They can be making profitable sales, making profitable transactions, but because they're offering a lot of trade credit to attract customers in, they have cash issues. So they go bust for liquidity rather than actually not being profitable. You can be profitable and have cash flow problems. That is important to understand, and we'll see that when we start analyzing a set of financial statements in weeks 8 to 10. Typically, the income statement has a number of different subtotals as you go down along. So you can see those if you want to have a look at your Ryanair. They have an income statement. You can see different operating lines as you go down along. We looked at the Ryanair's one before. We said the importance of ancillary revenue, the significance of fuel as a cost base. But likewise, Grafton Group, they have a number set of totals as they go down along. Operating profit, profit before tax, profit after tax. So have a look through all of those. You can see one from Concern as well, where it's slightly different language that they use. They don't talk about profit. They talk about surplus funds or income, because again, they're not really a traditional for-profit business. But it's nice to see the different layout. They're all saying the same thing, income versus expenses, but they might lay it out in a slightly different way, depending on the business model that they have. Right? So that income statement core principle is the income statement is based on the accruals principle, or what we call the matching principle. You match the revenue earned with the expenses incurred. And that's a huge area that actually has a new accounting standard, IFRS 15, International Financial Reporting Standard 15. Huge changes into how you recognize revenue in the last 3 to 4 years. And that has big implications for a lot of businesses because it's such a fundamental figure in a set of accounts. The other statement that we're going to look at in the next recording is a statement of cash flows. That doesn't worry about prepayments or accruals or anything like that. It just says, when was the cash paid? Put it in. When was the cash received? Put it in. So it's a much more straightforward, easy to understand cash in, cash out. But the point being, you can be a profitable company and be hemorrhaging cash. You can be a loss-making company and have positive cash flow. There's not necessarily a one-for-one link. And we'll see that when we look at the financial statements when we start analysing them. They're two important statements, but tell you different things. Yes, there is links between them, but they do tell you different things. Right? So what is the income statement or the statement of profit and loss used for? Well, how effective is the company generating wealth? Is it generating profit? We've seen in Ryanair, where's the profit coming from? We can see where the costs are. Fuel is a big cost base. We can see where the revenue is coming from, the importance of ancillary revenue. And it can be helpful in terms of forecasting as well, preparing budgets, looking at run rates in terms of growth rates. And when we start analysing, we can start to figure out, well, what are the unusual line item movements? Why is marketing expenses moving out of a disproportionate rate compared to revenue, etc. So it does give you a good bit of information. Some things to note here, however, is it is subjective. There are some things that are in a set of accounts, particularly the income statement, that can be manipulated. So certain things rely, for example, how you measure inventory, how you calculate what we call depreciation. So when you use long-term assets, you're going to write those off each year through depreciation. That's subjective, how it's measured in accounting. It also doesn't include some items that might increase wealth. So if you've increased your brand awareness, if you've increased goodwill or increased your exposure as a business, that's not going to be measured in the income statement because again, accountants can't quantify it. So it's just to bear in mind, it's a particular worldview of what wealth is. And there is a very important area that's done a lot of research on called earnings management, where directors and management can manipulate your profits through maybe aggressive revenue recognition. For anyone who followed the Tesco scandal a couple of years ago, that's what was happening. They were recognizing their revenue too early from commercial contracts with their suppliers because they were under pressure to hit targets. Or you can manipulate your costs, trying to avoid costs or try to put costs away in different places to manipulate your profits. So that's why the audit of these financial statements is so important as well, is that there is scope to manipulate profits. And again, false profit figures leads to poor decisions being made based on those false financial statements. So I want you to have a look through that. I'm going to put that Excel file up there. Have a look and make sure you understand that. We're going to have a chat. The first thing we do in week 8 then is we're going to talk through this, make sure people are happy with it, and go back and explain any topic that maybe is causing students a bit of hassle. And take a look at some of the sample income statements that are available. See what the key items are, and don't be afraid to delve into the notes then to get a bit more detail about the breakdown of particular items. That's a fundamental part of a set of financial statements. All right. So the last recording now we're going to finish up on next is going to look at the statement of cash flows, and we're going to finish off with a small bit about what an annual report is and what are the key components in it.